Welcome everybody to our webinar today on preparing your business for the ever-changing wealth tech landscape. I'm here with Matt Collis, who is Executive Director and Head of Wealth at Wealth Kernel. We'll move into introductions in a minute. I'm Phoebe Wallace. I'm Griffin Bank's Chief Revenue Officer. And today we're going to be talking about how the UK wealth industry has been undergoing significant change. We're moving away from a very traditionally dominated market with high fees and lengthy processes. And we're seeing tech companies lead the way we're making investment in making services much more cost efficient, much more convenient, and much easier. Open banking has been a huge driver of this change. We're moving towards a much more personalised and effective money management solution. And obviously, the eve of Consumer Duty has definitely shaped the wealth landscape and the products that are offered and raising the bar for all market participants. And so I'm going to hand over to Matt now to introduce himself.
Hi, I'm Matt Collis. I'm Executive Director and Head of Wealth at Wealth Kernel. Just by way of a background bio, I've had about 25 plus years in the wealth and investment banking sectors as both a practitioner and as an executive director. I'm a former board member of Brewin Dolphin, the large UK wealth manager, and also former chief executive of Stock Trade, the big D2C business. I joined Wealth Kernel in March of 2024, and have essentially been leading the push into the wealth market for our digital custody business.
Amazing. Matt, I'd love to examine some of the opportunities and challenges that have come up recently of who wants to offer wealth products and how they do it. How would you say the tech shift has affected or changed customer expectations in the wealth industry?
I'd fundamentally say that the expectations of customers have dramatically changed over the last 5, let alone 10 to 15 years to a certain extent. I think historically, wealth firms kind of gave a cursory nod to digital journeys, but customers now fundamentally are looking for a far more in-depth experience. Even in environments where their investments are fundamentally actually managed by a professional, they're actually looking to be able to do significantly more individually in terms of potential product selection and so on and so forth. I think that there's a much wider spread of products and services. I think what's really important here is historically in the wealth sector, customers tended to be tied to a single provider and be tied to that provider in some bases actually through an intergenerational wealth transfer to a certain extent. I think what we're seeing now is that one-stop shop offerings are not as popular as they used to be, and I think you can take the example of how millennials use neobanks. They don't just tend to use one, they tend to use 3, 4, 5, so on and so forth. And I think it's very, very similar that firms that are offering various forms of wealth or embedded finance get very used to the fact now that they're sharing their customers with 3 or 4 other potential entities, and the share of wallet, as they used to call it, is now spread across multiple parties rather than one party having 75 or 80% of it to themselves. I think the other thing that's important to think of here is that there is even where professional management of investments, professional management of wealth is involved, there's still quite an element of self-service in this marketplace. That's kind of UK was traditionally one of the first markets where self-service kind of grew to critical mass, and I think we have been overtaken by some of our continental European counterparts now in that regard. But I think being able to offer a multitude of services to enable people to have professional management of their assets, but also self-service as well, is very important going forwards.
Yeah, it's because the market's getting quite crowded, which is great for someone like me who I like to very actively manage my finances, and I am that millennial with 4 banks, and I will not apologize. But from a customer acquisition strategy standpoint, how do you think it's evolving, especially with self-service? Do you think there's still a lot of room for your more traditional managed approach, or is self-service king? Is that what's going to drive adoption?
I think the issue with the traditional approach is how those, and the important thing there is that the word relationship is going to come into it straight away, that they were historically built on a human relationship existing at first instance to a certain extent. And obviously what we're seeing now is that, you know, there is no face-to-face realistically at first instance. So when you're looking at people who are entering the investment market for the first time, now that could be with an entity that is providing investment services as their core business, or it could be through their banking app where investment is offered as well, or you're seeing other kind of lenders, payment services providers coming into the marketplace and kind of offering this early stage, do your investments with us at first instance, get your experience there, potentially move on, and so on and so forth. And I think the market is crowded, but I think fundamentally what we're tending to see is that people are looking at, first of all, savings is obviously really, really important. So, in some circumstances, savings is kind of a really, really good first tool to be able to offer to people. And it naturally kind of leads on into the investment market. But I think we're seeing brands that traditionally are from outside of investment or wealth or finance in general, just suddenly looking at customer bases and looking at what's happening with embedded finance and so on and so forth, and saying, well, actually, we have the brand, we have the trust, we have the relationship and the customer base, and we might not necessarily have the tools, the techniques, the skills, or the regulation to be able to do this ourselves, but we can certainly partner with somebody else, take the embedded approach, and kind of drive into the market that way. So I think, if anything, what we're likely to see is the market will get more crowded, and there will be winners and losers in that, obviously. But I also think that the shape of the market in 5 years' time will just look completely different to what it looks like now. And I think there will be names in that marketplace and brand names in that marketplace that today might be slightly surprising for some people, but it kind of, it would follow the trend of what we've seen happening in other kind of parts of the market where tech has really, really influenced and driven change.
And how would you say, what do you think the driving demographic is in wealth now? Because I think there's definitely been a step change with the younger generations being much more on top of their wealth and investments than, let's say, the generations before them.
Mm.
I know I definitely come from a family where I signed up to Charles Stanley or Fidelity years ago, and
Mm.
Fidelity has their pension and whatever else. But do you think where you have kind of a younger drive coming through, that the wealth offering has had to change?
I think so, because uh, what we've so many people have basically been kind of disenfranchised from the investment and the wealth market through either cost or kind of minimum entry values to a certain extent. And I mean, what we've seen with, particularly with things like fractionalization, is, the something that would never have happened when I was kind of starting out on my own kind of personal wealth and investment journey. Was, there wasn't that ability at very, very low cost to essentially start your wealth journey. I mean, your options probably were, and I'm going to show my age here, probably buying premium bonds at the post office, or maybe opening an execution only account with Charles Schwab, and not having the opportunity to get fractional exposure to investments that you had researched and really, really liked. And it's no surprise that when you look at fractional investments, I mean, it's heavy US tech stocks straight away, people buying Alphabet and so on and so forth. It's kind of that. But I think the market, it is fragmented still, because I think the younger generation, I'm losing track now of the XYZs, millennials and so on and so forth, to be totally frank. But I think the you know servicing kind of the market of people who are kind of sub 35 is very, very different to servicing the market that is kind of north of 40, and certainly north of 50 years old now. Now, I will add in here that I have an octogenarian parent who is quite happy with an iPad and an online app and fractionalization, but that not necessarily the case across the board. But I would say that the the journey has become easier for younger people, and fundamentally, I think where what we're seeing is people who are building apps are kind of thinking, well, okay, so what we need to do here is educate and try and get people on that journey. So I think that's why we're seeing, apps launch that have almost gamifying the investment experience to a certain extent and adding in the education piece. And I think obviously that appeals to a younger generation and brings them in. I think in terms of those that are already in kind of the wealth cycle via more traditional routes, they're just looking for more digital self-service fundamentally at this particular point. And I think they are fundamentally more demanding than they used to be, but I would say that there is going to come a time when all of these needs align. But I think at the moment there are still, segments of customers that you have to kind of approach with technology in a slightly different way.
Definitely. And I think you see this across the board. My personal nightmare is having to talk to someone on the phone, but my mother
Yeah,
now is against the chatbots of every.
well, you're absolutely right. I mean, this is the thing, and I see it. I see it amongst family and friends. There are those of us. I'm kind of like you. I'm really really happy if I can just basically do an online form or use a bot or whatever it might be and solve all my issues. The concept of kind of ringing somebody up and sitting in a queue and waiting to talk to somebody, no, I mean that's gone for me. And it actually, I mean, there's a lot of people who are north of my age who find that experience thoroughly frustrating as well and would rather be able to do it in an online fashion. But it is safe to say we do live in a world where there are still a lot of manual processes lurking around and a lot of manual relationship processes, and they won't disappear just yet, but they probably do have a finite amount of time left.
And do you think there is still a segment of the market which is really underserved despite the transformation of the industry?
I think so. I mean, uh, there is undoubtedly a proportion of the population in this country who are disenfranchised from savings and investments. And I think, you've only got to look at kind of global mobility, and you look at people who have fundamentally, they're moving on a global basis because their currency is not reliable, their banking system isn't reliable, their investment system isn't reliable, and they come to a country in Europe or the US, however, you know, whichever one it might be, with a more stable environment, and then find that they don't have access because they're not a national, they don't have an ID card, they struggle with banking, and I kind of EMIs have kind of solved this problem to a certain extent, but it's not really solved yet in the investment world. And I think that's something I think where the industry and the FCA and regulators globally have kind of got to work together. So this kind of disenfranchised group of people, have access to secure savings, secure banking and investments. I think the other area is, if you talk about disenfranchised and in a slightly different way, I mean, estimates suggest there are about 12.5 million adults in the UK alone who've, with probably combined asset base of around 700 billion, with no access to any advice for their finances. And if you work that out, you're looking at a kind of a floor level for professional support at about £200,000, and that number has ramped dramatically. And I think one of the reasons for this is that historically, and this isn't a negative comment towards the FCA in any way, shape, or form, but historically, what we've seen is that, as regulation has changed, there are businesses that have struggled to adapt to it in a cost-effective fashion. My hope is that, technology, in particular kind of core tenets of technology, will actually help to solve that problem, because it seems a crying shame that, you know there's that many people in the UK that are unable to access advice because it's too costly for the industry to deliver it to them. I think if we can use the technology to help. Let's call it like a low value AUM model. Um, I think that's critical, and I think the industry views it as critical as well, because fundamentally, this is the next generation of clients coming through. It's the pipeline of the mass affluent to a certain extent, and if we don't find ways to service it properly, it will be lost to us, and there will be a lot of firms out there who could fundamentally find themselves in the same position that some insurers were in 20 years ago, where their books become almost zombie books. There is no new throughput of business. I think that's a very, very important challenge that I think both the industry and the regulator need to work together to solve.
Yeah, I think it's much easier to access investment advice on YouTube or on Reddit with little to no regulation than there is through services.
Mm,
Do you think this is where traditional wealth managers have a little bit less of a challenge from a regulatory perspective than maybe wealth techs do? Because taking on the, I wouldn't say burden, but the responsibility of providing advice is a fairly high hurdle from an FCA
mm.
perspective.
I think you're right there, because the a lot of our regulatory environment is still kind of rightly or wrongly prefaced on the existence of a human relationship to a certain extent, and that's where the challenge lies. It's not just the relationship. I mean, a lot of the regulatory environment, it's the relationship and the behaviors of people within that relationship as well, whereas technology is fundamentally agnostic. um, I think we are seeing an evolution. So for argument's sake, we're seeing AI writing suitability reviews and writing letters, and at the rise of, I'm sure you have one, an AI note taker that does a very, very good job of tracing a conversation and even keeps the video just in case you're not quite sure what was said. And I think a lot of traditional firms are kind of using those, adding those tools to their kind of armory. Um, I don't necessarily think it makes life more difficult for them than wealth tech firms, or easier for them than well. I think it works both ways really, to a certain extent. I think the in terms of established firms, it's kind of innovating their approach to regulation and clients, rather than trying to migrate what they've already got built around their existing architecture and human relationships into a more digital world. I think from kind of the wealth tech standpoint, there is certainly the ability to be significantly more innovative and use kind of the tools that we're all now used to using in meetings and so on and so forth, and embedding them even further really into things like risk profiling and portfolio modeling and so on. I mean, I think we'll come on and talk about that in more detail. But I think both sides of the fence face challenges, whether it's legacy or whether it's a new firm. But I think they're almost binary in terms of what their positioning versus those challenges actually is.
Um, and I guess building on that, the point you made about portfolio modeling is really interesting. But what are like the big hitters, the big pieces of innovation that are going to reshape the industry over the next kind of 18 months to 2 years in your view?
I think the interesting thing here is that everybody is going to expect me to say AI, and I am going to say AI still. But I think it's how it's used and how you apply it. And what is what is really interesting is, if you rewind through the industry over 10, 15 years, and you go back to kind of the birth of model portfolio services, which were designed to service mass affluent or lower value AUM models.
Yeah.
And the industry's issue and the regulators' issue with that at the time was how you justified a one size fits all kind of approach, and how you justified a small number of risk profiles and a small number of outcomes and a small number of model portfolios. How could my needs be the same as yours? Or what was the likelihood of somebody of the same age as me living in a different city, with a different set of kind of plans over the years and outcomes and school fees or whatever it might be? How could we be the same? How could we fit the same model? I think where AI is going to be really interesting in this is that it might lead us back towards an efficient way of being bespoke, as random as that might sound, because the power there enables us to be much more granular in terms of risk profiling, scenario modeling, and even portfolio modeling to a certain extent. And I can, there is an irony, and I get it. And as I say it strikes me as massively ironic that what AI almost empowers us to do is to kind of broaden what we can offer on a on a cost and efficiency basis, and kind of take, let's call it MPS, to the next level, but almost taking MPS back in the direction of being more individually tailored to you and I than it is in its current form.
Yeah, I guess it kind of merges that very bespoke approach of the someone who is significantly wealthy going to a very high end wealth manager, but making it available for for the masses.
Yeah,
Um,
I think if you look at that, I mean yeah, obviously I remember the birth of suitability as a regime, and the you know it, what was really interesting is that there was a running joke, I think probably in the profession at the time, if you go back 12, 13 years, that you'd visit a firm and you'd look at all of the portfolios that it was running, and there'd be a version called medium balance that would be like 80% of the portfolios within the firm, and you would naturally ask the question, how can that be right? How can all these people kind of fit that and have require all the same outcomes that this portfolio is producing? And MPS kind of helped to deal with that to a certain extent, but again, you were talking in a lot of firms maybe 6 or 7 different risk profiles,
yeah,
countless different forms of outcomes, and maybe 10 portfolios. And there is still the argument then that when you measure your outcomes from those portfolios, do they map back to what that client actually needs to be delivered and what they wanted? And I think that's where AI will help, because I think it will enable us to almost explode out what can be delivered and how tailored it is, and actually also be able to demonstrate effectively that we are, carrying out processes, building portfolios that are going to deliver the right and the best outcomes for those customers.
yeah, because I think this brings me on to my favorite topic, working in financial services at the moment, which is consumer duty. And if you look at suitability, eligible investor status, and all of those concepts, I know through the platforms I use that it is quite easy to click through a suitability questionnaire. Um, there is no one physically checking that balance as you would have had 20 years ago if I went and sat
Mm.
in a wealth manager or a private bank. But how do you think consumer duty is affecting, but also how do we balance consumer duty with a super convenient embedded wealth offering and actually kind of protecting the best interests of retail customers?
I think that's fascinating, because one of the first thoughts that crops into my head when we talk about manifesting consumer duty in a digital world is that concept of people simply just scrolling to the bottom of T's and C's and accepting them. And how on earth do you get that to work in a in terms of making the communication with the customer not only fair, not in any way misleading, easily understandable in clear language, but also actually just making sure fundamentally that they have read and understood it. And that's a really difficult challenge, and I think that's where we've got to be very, very careful that we don't let the digital experience dilute the customer's understanding under consumer duty. And I think, coming back to something I said earlier on about bringing education into apps, almost using kind of education, a role play, and other tools in the communication methodology within an app is a very good way to do it. I mean, I kind of, for argument's sake, I watch my daughter play video games, and there's always that concept of like a training thing to start with, to kind of understand the controls and what's happening and who's doing what and so on and so forth. And I'm seeing apps where that is kind of playing a part to a certain extent. I guess there is a question about how you gauge when somebody is deeply enough engaged and understands enough to be able to move to the next phase. And I think what we need to get away from is this concept of people have ticked 6 boxes and on that basis everything's fine, because that's not what this is about at all. I think the interesting things that are, I mean, Consumer Duty was long overdue, and I applaud what it's trying to achieve, and I think there is finessing that we still need to do in conjunction with the regulator to get it to do what it really needs to do. But I applaud its aims, and I mean, I look at the other side of the fence around what I would have called value for money, but fair value, and demonstrating that assessment, designing products that actually work for people is just so important as well. I think what I am seeing is that it is, and this is true, I think, in both the digital world and in the legacy world as well. It is changing the way that people engage with customers. People are clearly thinking about it far more than they used to, and you've only got to take a cursory view of a few of the big players' websites and look at the client materials and spot where the changes have happened over the last kind of 3 or 4 years. And I think the good thing here is that Consumer Duty will continue to innovate. It will continue to change because, as we see the market and the ecosystem kind of shift, we're seeing more digital service, we're seeing more entrants into the marketplace. They're having to kind of look at Consumer Duty, and we have a lot of conversations with tenants who kind of come to us with their investment propositions, and we talk about Consumer Duty, and for some of them it's the first time it's ever manifested, but none of them look at you as though it's a terrible thing or though it's onerous in any way, shape, or form. I think it's possibly there was a component of the legacy industry that looked at it in a similar way that people perhaps looked at suitability all those years ago and said, well, of course, what we do is suitable for the client. Of course, our clients understand what we're delivering to them. They certainly read our documentation. I think the new entrants, they don't carry that kind of preconception that why would you ask these questions? Surely that must happen. And I think that's really, really helpful. But I think the other thing is that, you know, what we're seeing with consumers now is that they are significantly more savvy and significantly more engaged. And the younger they are, even more so to a certain extent, they understand where all the costs are in the financial ecosystem. If you went back over a period of years, there's a lot of investors that didn't understand, let's call them the hidden costs within traditional funds. And now they do because of disclosure reports, and it's making them ask questions, about the investment proposition. Why are you using this fund? Why are you not using this ETF? So on and so forth, and all things like that. And I think actually, the transparency that the Consumer Duty brings in that regard as well is really going to change. And I think fundamentally the answer here is the Consumer Duty actually good for the end consumer? Yes, categorically.
And I guess this kind of brings me to a topic which is central to both Griffin and Wealth Kernel's business models. Um, we we launch products with firms that aren't necessarily financial services firms. They're unregulated. We do it from a banking proposition, but from a wealth product proposition, how do customers move from being fully unregulated non-financial services firms to being able to offer wealth products?
I mean, so realistically, if you are, let's say, a retail brand that suddenly turns around and says, I want to start, I've got all these loyalty card customers or so on and so forth, and I want to kind of transcend my business model. And savings is clearly a very, very good place to start, because fundamentally savings is not sitting on the regulated activities order to a certain extent, and there isn't a regulatory kind of requirement there at that particular point. If you're going to step over into the investment world and fundamentally look at offering access to ETFs and funds, self-select, robo-advice, whatever it might be in that sense, at that particular point, we're seeing kind of some of the embedded finance kind of come into play there, where essentially, but you have to bear in mind in that example that you're basically jumping into a partner who is regulated to deliver those services. What we do is we work with a number of fintechs who in themselves are not directly authorized by the FCA, but they utilize our appointed representative regime. What that does is essentially grant them or license one of our permissions specifically, and it enables them to offer self-directed investment products to their end customers. We also make available, obviously, our product wrappers. So we're an ISA manager, a SIP manager, administrator, and trustee, and fundamentally it lets them kind of test their business model and offer that investment experience to their customers, that initial kind of wealth experience to their customers. And what we tend to find is that they mature and they actually pursue direct authorization with the FCA, which is how the FCA likes that model to work. It's almost kind of, they have their own almost innovation and sandbox environment now for firms to become regulated, and the AR regime is kind of very, very similar to that. It's a great way for firms to test their business model for in the investment space at possibly a slightly lower cost point. What we do is we essentially in that market, we are the regulator. We are supervising them, and we do so to a very, very high standard, almost as if they were actually directly authorized themselves. And it's a great tool for us. We use it selectively with the right firms, and obviously we have oversight and we have to understand their business model. But I think for wider kind of in the wider unregulated market, savings is becoming, it's really, really, really important, because fundamentally, these businesses can come to you and essentially open that relationship up, and there isn't the regulatory kind of requirements sitting there at the moment. We are really, really lucky to be partnered with you to provide that service actually through our CAS infrastructure, and obviously with all the FSCS protections that are provided as well. That's a fabulous tool, and I think for a lot of people, and it is the first step on the road into savings is the first step to investments. It's the natural step, and yeah, that's very much front and center in the proposition that we're kind of putting forward into the marketplace at the moment.
Yeah, it's always very vindicating to have partners like Wealthcon or working with Griffin to bring these products out, because we place a huge lot of trust in our customers, and in the same way that you do, and so the standards are kind of upheld across the journey, which makes our lives much easier and yours. We've had some questions come in, but
Okay.
kind of last big question for me is, where do you see the greatest opportunity for growth in wealth and wealth tech over the next 3 years, and how do businesses tap into it?
I think realistically, from a growth perspective at the moment, I think there's what we've seen from a lot of kind of the partnership opportunities that have built up over time is to a certain extent firms coming together that don't appear to be natural kind of bedfellows to a certain extent, and that kind of started with banks kind of aligning with investment houses, because the proximity between your current account and your discretionary portfolio, I mean, the smaller the distance between those two things, the less latency there is, and the more likely there is for you to kind of start investing. I think realistically we're going to see the gap between kind of banking and wealth start to close again, because traditionally, if you rewind a number of years, banks, building societies, whatever we wish to call them, were traditionally very, very embedded in kind of the wealth and the investing space, and they essentially started to become disenfranchised 15 to 20 years ago. I think that there will be we'll see growth through a closer alignment between traditional and neo-banking and wealth and investment products. I think that will happen. I think we will see significant growth as trusted brands in other areas decide to leverage their customer relationships and the trust that they've built and the brand that they've built to kind of enter the wealth and investment space. I see ETF investing becoming the norm to a great extent going forwards. I really, really do think that that is going to be a massive, massive growth area. But I also think that we'll continue to see diversification of service offerings. We'll continue to see people who want a fully self-selected D2C experience. We'll continue to see people that, fundamentally will essentially want to be able to kind of put their money in a place with a professional management team and kind of walk away from it to a certain extent. Where do I see the most growth? Realistically, I think we've got to solve the advice gap problem. I think there's a massive, massive opportunity there that we need to work together as an industry to resolve. And I think there are a multitude of participants in that. I think there are partners like Griffin who are kind of involved in that market. There are advisors who are in that market. There are custodians like us in that marketplace as well. And having sat here and described that those almost orphaned assets as being worth 700 billion. I mean, if you compare that to the overall size of the industry, that has to be the growth target going forwards, definitely.
Yeah, it's a huge amount of money, which is just lost in the ether, or not lost in the ether, but it's not bringing good value to the holders of the funds or
No.
the investment landscape itself. You've kind of covered this question off, but a question we've had come in is what partnership models in the wealth industry are proving to be the most successful? I guess, is there anyone that you'd call out as particularly impactful?
I mean, I think it's difficult to look past. It's difficult to look past kind of again the banks and aligning with a kind of a brand name investment provider. I mean, I'm thinking the kind of the Chase Nutmegs of the world and so on and so forth, because they solve it's just almost a very obvious problem to a certain extent. I've got and there is an argument as to why larger kind of traditional banks have perhaps not caught on and kind of done that themselves, because there are some very large players out there where I could log on to my account and I could look at my current account and I could look at my savings account and so on. And at no point am I offered an opportunity to go and invest my money somewhere, do a self-select, open a SIP, doing whatever it might be. And I think, the neobanks are all thinking of this and all traveling down that particular path. But, I think if you look at how much of the UK marketplace is captive to like 2 or 3 major banks, they have to be looking at those types of partnerships and thinking, well, that's something, surely we're sitting on the assets. Surely there's something that we can do there. I think the other partnerships that seem to be working really, really well are those where, you've got kind of EMIs where they're looking at like roundups and fractional investment and so on and so forth. And they're giving people the opportunity to, I think, do what people do in McDonald's and just kind of round up to a charity donation, but instead you're rounding up and it's going into an investment. And you don't necessarily need to, I think the beauty of that is that you don't necessarily, as the customer, need to be hugely au fait with exactly what that investment is. That might sound terrible, but if you bear in mind that it's probably going to be a curated set of funds that your questionnaire and your risk profile selects for you, and then fundamentally when these roundups occur, it's just topping up. And if you are 22 years old, you're going to have quite your risk appetite at that point is going to be reasonably okay, because you've got lots and lots of years left to build that pot. So for argument's sake, my daughter is 11 and her portfolio is, name it, Vanguard Life Strategy, 100% equity. And that is absolutely fine for her, and it just tops up and so on and so forth. I think those kind of I'm going to say it's invest without thinking about it, and I mean that in the good way, not in a negative way. It's the fact that you kind of have selected to do it, kind of like giving blood or kind of like being a donor. It's just going to happen for you. I think that those types of partnerships work really, really well because you don't have to keep re-engaging over and over and over again. It's just working in the background. It's building that pot for you. And as a practitioner, I'm always going to talk about the benefits of compounding over years. The sooner you start it, the better.
Yeah, we're a big believer in convenience with Griffin. So we partner with a number of firms to provide savings accounts as part of your payroll offering. So pre or post tax benefit, holding back
Yeah,
ones, whatever, as to top up your savings each month is a really smart way of saving without having to think about it. Because I think the minute you give someone a choice of, well, I need to move money in this direction at this date, it becomes so much more complicated and much less
yeah.
appropriate.
I think that's amazing. That's brilliant because you've got essentially you've got your pension deduction happening, you've got your savings deduction happening, and you don't have to think about it. And I think I talked recently. I don't know whether I can name them at the moment, but we talked recently to one of our tenants who's kind of developing a proposition where the fundamentally the founder of the business benefited from a decision like that being made when she was a baby and getting to kind of adulthood and without any real effort by her parents, all of a sudden there's a pot and security and so on and so forth, and it was fundamentally driven by we start the process here, we make it automatic, and then we just leave it, we don't interfere with it. It's similar to people build junior ISAs and they basically just set up a monthly, weekly direct debit, whatever it might be, and provided it sets the level that you can tolerate and is suitable for you and so on and so forth. I mean, that is a very, very, very good way of basically investing without having to think about it.
It's allowing people to make very smart but passive decisions.
Agreed.
It's very key. Another question we've had come in is there's talk that there's oversaturation to a point in the savings market. For wealth techs looking to get into the space, what are ways do you think that they could differentiate their offerings to stand out or gain traction?
I think realistically, I mean, there's so you've got the savings market. I mean, you can look at kind of the wrapper capabilities around kind of cash ISAs and so on and so forth as well. And there's a level of interoperability there that I think is worth considering. I know that there are propositions out there where the savings are kind of almost aligned with loyalty bonuses and so on as well. So you might have kind of retail agreements or loyalty cards, and I think there's all manner of ways fundamentally that firms can differentiate in that regard. I think what is interesting is that consumers are very, very savvy, and at first instance they're rate focused, and that's the it's the rate focused, and then what are the other benefits, the loyalty benefits, so on and so forth. What is again, perhaps the interoperability with some of the other services that they have, and so on and so forth. But I don't necessarily think. I mean, I've seen. I read an article the other week, and I'm afraid I've completely forgotten which journal it was, about we're kind of reaching critical mass in this market, and that we'll start to see what always happens in a market with critical mass, which is we'll see firms start to come together and some consolidation. But I think there's so much differentiation out there, and I mean, you can essentially take that route away from the rates and look more at the other products that you can supply. You can look at, again, kind of the loyalty, the bonus, the roundup, so on and so forth. People are tying in with retailers on the loyalty card schemes as well, and then there is also the the positioning to service a sector, a particular society, so on. We're seeing elements of that as well. But similar to, I mean, we saw a mass kind of consolidation of the platform sector in the last 10 to 15 years. We've seen big consolidations in the wealth and advice sector over the last 10 to 15 years. I think fundamentally it will happen in the savings market in the end, but I think it'll be kind of propositions like Griffin's that will probably are best positioned to kind of wade through that and potentially be the party that sits there at the top of the tree.
Yeah, it's been an interesting few years. I had a saver with a large high street bank that I'd had since I was a teenager, which still, despite the base rate going to 5.25%, was paying me 0.1. Um, and a lot of these accounts still exist because you inherit them, right? Or you have them and you don't do anything with them.
Absolutely, absolutely. I think that is I think back to the differentiation argument. I mean, the expectation in the digital environment is that rates move, your rate moves. The expectation in perhaps the legacy marketplace and the mortgage environment to a certain extent as well is that rates move, and then, or particularly when they go down, they particularly when they go down, and I'm specifically talking about the mortgage market in that scenario, they don't tend to move particularly quickly. And in the savings market, as rates go up in legacy environments, you don't tend to get the enhanced rate until significantly later on. I think what I really like about kind of the tech empowered savings market is the lack of latency across the board.
Yeah, I think there's a really interesting kind of market dynamic there where you have to maybe get your money out of a legacy provider, but the value you get by doing that is huge.
Hmm. I would agree. I would agree. I think the days, to be frank, the client bank for those types of services is only getting smaller over time, whereas the client bank for Griffin is growing.
Um, and I guess from Wealth Kernel's perspective, what are you most excited about? What have you got coming up that's really galvanizing you into the summer?
I mean, at the moment, so savings is huge for us at the moment. I mean, we're on the very early stages of our journey with Griffin on savings. We've had a lot of interest already on the back of the campaign that we've kind of pursued through social media and the other sources, and we're proactively talking to a number of partners that are keen to utilize us to access Griffin already. So that's great. We continue our push into the wider wealth management sector at the moment. We're looking at essentially going back to that kind of that advice gap and low value AUM. We're in the process at the moment of looking at how we can retool certain aspects of what we do to potentially help firms solve that particular problem. We're looking at solving issues around fragmentation of investment assets. So we talk to a number of advisors who are having to use a multitude of platforms to service similar clients. And we're trying to help them find new and innovative ways to actually make that efficient by kind of aggregating into one solution that they fundamentally own. And driving forward, seeing more innovative fintechs come forwards, more innovative wealth techs come forwards. I mean, every week at Wealth Kernel is different. It's wonderful to see. We're very, very lucky because I think we're so well known in kind of the fintech and the wealth tech world that very few propositions come into the marketplace that we don't get to see and understand and have a look at. Whether we end up working with them or not, to a certain extent, isn't the point there. I think it's the fact that we can just get to see the directionality of the marketplace, and that obviously helps us to develop what we have and innovate. So rather than one of our customers turning around to us and saying, we need to do this. Is there an API for it? By the time they actually come to our front door, it's there.
Yeah, I think that's one of my favorite things. If you got an API to do this, and it is very easy to get that up and shipped.
Absolutely. Absolutely.
Well, thank you so much for your time today. This has been genuinely fascinating. I've really enjoyed it. I hope you have too.
It's been an absolute pleasure. Thank you very much for having me.
Great. Thank you.